Good afternoon, everyone, and thank you for joining today's webcast. My name is Reece Pang, and I am KPMG's Head of Indirect Tax here in the Lower Gulf. With the worldwide focus on base erosion and profit shifting by the OECD and the UAE's commitment to implement certain anti-BEPS measures, many international tax concepts such as transfer pricing and country-by-country reporting for some businesses have been on the horizon for some time. However, these new economic substance regulations have much broader application and are the first corporate tax-related rules that many in the UAE have ever had to deal with, and that novelty has caused great uncertainty. Next slide, please. It's my pleasure to introduce Nilesh Ashar and Anush Kapoor, my partners here in the UAE, specialising in international tax matters. They are perfectly placed to help you navigate through these complex and important concepts and your obligations, having helped many of our clients to do so already. Next slide, please. If you've been joining some of our previous webcasts, you've heard from us on the background of the economic substance rules already. So in today's sessions, we propose to get granular. Nilesh and Anush will focus on the practical issues we have seen, classifying our clients' businesses as falling within some of the key 9 relevant activities and the notification requirements and the deadlines of the various regulatory authorities. Once we get past that assessment and notification period, we will run further sessions focused on the practical aspects of the substance test, core income generating activities, and the detailed reporting requirements that you will need to meet later this year. Next slide, please. Please provide your feedback at the end of today's session so that we can continue to improve. If you have any technical questions, please use the question mark button and a member of our team will reach out to you. You can also use the question chat box in the player to raise queries, which will be passed on to our presenters, which we will address at the end of the session. With that, I welcome you to our webinar and pass you over to Nilesh.
Thank you, Reece, and good afternoon, everyone. Welcome to our webinar. By now, I think it's fair to say that many of you may have already attended several sessions, KPMG and others, and may have already a background on the economic substance rules. We'll cover through those fairly quickly and then run into some of the relevant activities and an explanation on the activities and try and understand them in a bit more detail. Next slide, please, Claire. Thank you. So as many of you may be aware, the economic substance regulations were issued in the UAE by the UAE authorities in direct response to UAE's commitment to the OECD and as part of UAE's review by the EU of its tax framework system, where UAE was put on the EU's blacklist. And the primary objective of these regulations are to ensure that UAE supports the OECD in its initiative to ensure that jurisdictions such as the UAE and the others that do not have a corporate tax system are not used by multinational companies and others to artificially attract and retain profits in the UAE, where there is no genuine economic substance backing those activities. So the regulations apply to all UAE entities and licensees. And as many of you are aware, you generally need a license to operate in the UAE. It applies to all entities, including branches and rep offices, regardless of whether the entity is set up in mainland or free zone. There are exceptions if you're 51% or more government-owned. And importantly, the regulations are already in force effective 1st of January 2019, effective financial years commencing on or after 1st of January 2019. The essential requirements of the regulations are to ensure that if you are a licensee that carries on one of the 9 relevant activities, then you need to meet the 3 key substance tests, which are centered around the core income generating activity, or CIGA, being carried on in the UAE, the entity or the relevant activity being managed through board and directors that are present in the UAE and minuted in the UAE, and adequacy of expenditure, employees, and assets in the UAE, with a substance over form to be followed in making that determination, as opposed to just seeing what your license may state. The key practical compliance requirement, and we'll touch on this in a bit more detail during the course of this session, is that there is a notification requirement that's coming up on the 30th of June for financial year 2019, as well as an ESR report that will follow within 12 months of the end of the financial year, with the first reports due on 31st of December 2020 for year ending 31st December 2019. Next slide, please. This just gives you the important timeline just in terms of how the regulation was introduced. I don't intend to go through all of the details, but the regulations came in force on the 30th of April, and subsequent to that, a number of guidance and FAQs have been issued by the Ministry of Finance as well as the relevant regulatory authorities. The most recent one being from the Ministry of Finance confirming the 30th of June notification deadline and confirming that there is no change in the return deadline, which is 12 months from the end of the year. Next slide, please. In summary, so I think every taxpayer or every UAE entity may or may not be a taxpayer. Every UAE entity that carries on a relevant activity needs to be in compliance with the regulation. However, and then needs to make the notification and the report requirement. The key process that every business needs to follow, the first step is to determine whether or not you're carrying on a relevant activity, and then going on from there to see if you qualify for any exemption and if you earn any income from that activity. If you carry on an activity but do not earn any income therefrom, you still need to make the notification. If you do derive income from the relevant activity, you do need to go forward and see that you meet the substance tests, and submit a return by the end of the year. There are penalties associated with non-compliance, and my colleague Anuj will touch upon those as part of the notification session. Next slide, please. Now, just spending a few minutes on the relevant activities. Next slide, please. So, as I said, there are 9 relevant activities that are in the scope of the regulations. We cover 5 on these and 4 on the next slide. I don't intend to go through the detail on all of this, but essentially the 9 activities are distribution and service center, holding company business, IP business, lease finance, HQ business, banking, insurance, investment fund management, and shipping. Distribution and service center businesses, essentially where you are purchasing goods from related parties, importing and distributing them outside the UAE, and services being provided to foreign related parties, you're in scope. It is important that this is the main activity of the entity to be in scope of the business, of the relevant activity for distribution and service center. For holding company businesses, there are reduced substance requirements, but essentially a holding company business is one that primarily owns shares or equity interests in a company, and importantly, it does not carry out any other commercial activity as part of its business. And I think to the extent holding company businesses exercise control over subsidiaries, that's the key criteria under the federal law number 2 of 2015 for a company to be a holding company business. So you need to look between holding companies that own minority interests versus majority interests to see whether they would be in scope or outside the scope of the regulations. IP businesses, we've got certain examples that we'll run through them, but predominantly if you're exploiting IP and charging identifiable sources of income by way of royalties or franchise fees, you're in scope of an IP business. There are enhanced IP, enhanced restrictions or enhanced substance requirements for high-risk IP businesses that one needs to be mindful of. We'll touch upon those in a bit more detail. Lease finance business predominantly includes functions or activities where you provide credit for consideration. So any interest-bearing intercompany loans or third-party loans, lease finance arrangements, hire purchase arrangements are all in scope of the regulations. The key exclusions are for debt instruments that are traded on a regulated stock exchange. HQ business is one where there is an entity in the UAE that may be providing services to group companies outside the UAE around coordinating group functions, assuming material risks. So many of you on the webinar who may be having performing a group function as heads of tax or CFOs or group financial controllers, and where your costs are recharged to foreign entities. Foreign group entities, you're likely to be in scope of a headquarter business. Next slide, please. Wrapping up with the other 4 categories of relevant activities, 3 of them are financial services related. So banking, fairly straightforward, where you are likely, where you've been issued a license from the central bank or from the IFC or ADGM. For accepting deposits or loans. You're a banking business. Exceptions are for businesses such as exchange houses and banking advisory businesses. Those are out of scope. I'll come back to insurance. I'll come back to shipping. But insurance business, again, if you're regulated by the insurance authority and provide both life and non-life insurance, you're in scope. Exclusions are for insurance brokerage or advisory services. Those are not in scope for as an insurance business, but you need to consider whether those could be in scope for other relevant activities. Investment fund management businesses are those where there is discretionary investment fund management services provided to collective investment vehicles, essentially around making investment or divestment decisions and risk-related decisions on behalf of a fund. The notable exclusions are for fund administration, custodian, and investment advisory services. And last but not the least, shipping, all services involving the operation of ships in international traffic is in scope of the regulations. If as part of the shipping, as part of the operation of ship, if you do provide the agency or ticket selling or cargo booking services, those are in scope, but only if you operate the ship. Exclusions are for pure travel agencies or ships leased on bareboat basis. So that's a broad description of the relevant activities. I think it's fair to say that you could fall within the scope of more than one relevant activity. And there are some notable exclusions to avoid duplicate reporting in certain cases, particularly for distribution and service centers and headquarter businesses, where you do not or may not need to report for both of them if you are carrying on certain other types of relevant activities. Next slide, please. Just briefly running through the tests, the economic substance test. Now, we don't intend to cover on this webinar a detailed discussion on the test, because as part of the notification requirement, which is due on the 30th of June, we don't necessarily need to, we don't have to confirm that we meet the test, or the entities that are required to notify meet the substance test. So we will cover this in more detail in another webinar to follow. But essentially, the tests are around whether the entity that is carrying on a relevant activity and earning income from that activity is managed and directed from the UAE. There are prescriptive guidance provided under the regulations as to what is regarded as directed and managed, including board meetings to be signed and taking place and maintained in the UAE, directors to be physically present, particularly the quorum, and for the directors to be adequately qualified. The second test is around the core income generating activities for each relevant activity. So again, there is a detailed description in the guidance and the regulations around what is a SIGA for each relevant activity, and we need to have demonstrable evidence that the SIGA is performed in the UAE as part of the reporting that is due later on in the year. And last test is slightly more subjective around the adequacy test. Every entity that carries on a relevant activity and earns income therefrom is required to prove that they have appropriate qualified full-time employees, appropriate operating expenditure, and physical presence in the UAE. These are the 3 tests that have to be met and demonstrated that they are met and will need to be submitted along with a certain other information in the economic substance return that will be due at the end of the year for 2019. As I said, we will cover these in more detail in our next webinar. But the focus of this session, as I said, is to cover more on the notification requirements, and which is due on the 30th of June. And I'll hand you over to my colleague Anuj, who will run through the notification form requirements and some of the practicalities associated with it.
Thanks, Nilesh. And there's clearly more than what meets the eye when it comes to the footprint of each of the relevant activities. And this gives us a good segue into what I assume many of our participants are likely to be busy with, which is the notification filing. Now, as we would appreciate, this is the very first time you will be adopting an international tax position within UAE. This is the very first instance where you will take a stance and lay the foundation for your overall ESR profile. And the notification is the very first official document trail you will create in the records of the regulators, followed by, of course, the economic substance report. So if we move on to the next slide, what we have tried to do here is summarize the various due dates, which are driven by the location of your respective UAE entities. And this also shows the texture of UAE's legislative framework, whereby you really need to maneuver through multiple regulatory authorities who have pinned different due dates for the notification filing. And there are also subtle peculiarities to pay attention to. For example, as compared to the Ministry of Economy, which is, of course, the regulatory authority for mainland entities, the filing requirement of notification gets triggered only if the mainland entity undertakes a relevant activity during the reporting period. But in contrast, for quite a few free trade zones, the notification is a mode of communicating what is your ultimate ESR position, and hence the notification requirement is irrespective of whether or not a relevant activity is being undertaken. So as we can observe, 30th June is coming across to be progressively a cumulative due date for various instances by which the notifications will have to be filed. And moving on to the next slide, here we are trying to really, as a reference point, discuss the template which you would tend to come across while there are again some commonalities on the forms. At the same time, different regulatory authorities, there are certain nuances to be taken care of. You ought to encounter them in your process of filing this notification. But really, the outbreak is the first instance. You will be submitting your basic data about the licensing and where do you see yourself falling within the 9 listed activities. But more importantly, drawing attention to the next slide, there will be required to be information around your ultimate beneficial owner in case of a high-risk IP business, and also drawing attention to the requirement of whether a UAE entity is a tax resident outside UAE. And I think this is the context which you need to consider specifically in case of branches in the UAE foreign company. Now, as we see, foreign branches are not considered to be residents in UAE. A proof of that is the tax residency certificate, which is typically not issued to a branch of a foreign company in UAE. And in that instance, you ought to be considered as tax resident outside UAE. In addition, one also needs to assess whether, on account of your international business operations, any distributor or agency networks, or any overseas travel of your key personnel, if the UAE entity has the exposure of creating a taxable presence, such as, say, a permanent establishment outside UAE, these schematics would very well need to be plugged in. Lastly, towards the bottom of the form, you will observe the disclaimer, and reading between the lines, clearly the entire responsibility of the accuracy and the completeness of the notification vests with the submitter. Moving to the next slide, we'll try and cover some of the practical aspects on course of filing these notifications. Now, as far as the question of single versus multiple notification filings is concerned, while each case is on its own facts and circumstances, the starting point surely is that notification filing is qua each licensed entity. So whether you're a branch or a company, irrespective of your IFRS position on consolidation, irrespective of your VAT grouping position, each entity is on its own footing of analyzing whether you fall in scope or out scope, and accordingly making good the notification filing independently. Of course, there could be instances where a UAE LLC has multiple branch licenses which have been obtained because of the licensing law of the land. And in such cases, if the respective branches are not likely to undertake separate relevant activities, then the logic prevails that probably you will end up submitting the notification for the main LLC, and to the extent possible, you'll populate the branch-related information into the same filing. However, each case, it's on its own merits, and to conclude on this single multiple filing, the facts of the case would really drive your conclusion. For government-owned entities, while there are certain leeways given on or exemption offered to some extent, I think it's important to note that the notification forms very well ask the question on the government-owned entity position. And if inference was to be drawn from these information being asked, clearly the government-owned entities also have the obligation to file the notification so as to enable the regulators to evaluate the extent of the exemption to be applied on full compliance. Now, in context of an entity which is at some stage of a liquidation or winding up, unless the commercial license has been cancelled before the new notification filing due date, even such entities, while they might be under the process of wind up, could very well likely to have the filing obligation. Lastly, as of today, there is no requirement to file or upload any documents along with the notification. It's neither the audited financial statements. These are all good data points, but ultimately it's a notification form which will have to be submitted in the first instance. Now, one popular question which gets raised is what's at stake for non-compliance? So if we move on to the next slide, this really summarizes the penal implications which could arise on any inaccuracy or any sort of non-compliance to any element of the regulations. Here, in addition to the financial penalties, I think the more crucial consequence from a local standpoint is the potential sanctions on the business license as a result of any inaccuracy or non-adherence. And secondly, in the global context, the regulators have the authority under the exchange of information commitments to share the tax data with the counterparties outside UAE, as the case may be. And this is really how UAE, irrespective of its local corporate tax profile, which is very thin, is intended to be plugged into the global international tax fraternity. Moving on to the next slide, we'll try and touch upon some practical examples of popular business models. So the first one is really the drop shipment model. I'm sure we all have a liking towards drop shipment model in the case from a VAT perspective, where the goods do not enter the jurisdiction of UAE and they are transshipped directly from source to destination. I think in this instance, the critical part is for ESR purposes. Interestingly, if you read through the relevant activity guide, the conditions around the actual import and storage of goods into the country are no longer included in comparison to the base case definition of what constitutes as a distribution business. Again, emphasizing on the substance over form approach, the ESR focus is to substantiate the revenues and margins booked in UAE. Unlike VAT, which is a transaction level tax, and the relevance is more on the actual movement of goods. Moving on to the next slide in interest of time, and we have added here an IP-related revenue to in a way add a complication to the standard trading business model. And there are specific conditions prescribed for qualification as an IP or a high-risk IP. And these conditions circle around the role played by the UAE entity in generating IP revenues, whether such IP rights have been acquired by the UAE entity from one of its group entities. And these are really sensitive data points and terminologies such as acquired and what constitutes a group do not categorically find their place as definitions under the regulation. And hence, again, the onus is really on us to adopt a substance over form approach and finally determine whether an IP revenue generation in UAE triggers a qualification under high-risk IP business, which automatically leads to a much higher governance of substance regulations and a much higher data flow across borders. Moving to the next slide, in this instance, we are referring to a UAE entity providing services, and this could be very popularly the shared service model, where irrespective of a markup being charged or not, even a cost-to-cost recharge tends to create a tax deduction in the overseas or the non-UAE side of transaction, and thereby could very well fit into the services definition under the distribution and service activity. The only protection being a provision whereby any ancillary services could be avoided, but even to take such a position would need a much more informed decision to say it's a one-off and an ancillary service and hence could be disregarded. Again, emphasizing on the substance over form approach beyond what meets the obvious. So with that, I hand it over to Nilesh to take us through the remainder slides.
Thanks, Anuj. Just looking at some additional examples of other relevant categories or other relevant activities. So for a holding company, in this example, as you can see, ABC LLC holds 100% of shares in XYZ LLC. Both ABC and XYZ are carrying on commercial activities in the UAE that are not otherwise in scope of the regulations. In this case, even though ABC LLC holds XYZ LLC and earns dividend income from that activity, neither ABC LLC nor XYZ will be subject to the regulations. And ABC in particular will not be regarded as a holding company because it carries on a commercial activity, which is manufacturing of food products. Next example, please. Now, in this case, you've got a holdco in the UAE that owns subsidiary 1 and subsidiary 2. Both subsidiary 1 and subsidiary 2 provide, issue or declare dividends from time to time. But UAE has also provided an interest-bearing loan to subsidiary 1. In this case, UAE will not be regarded as carrying on a holding company business and instead will be treated as performing a lease finance activity under the regulations. The practical challenge that we will have is that if the UAE company is in mainland UAE, the regulatory authority to make the filing for a lease finance business is the central bank. Now, if the UAE is a pure holding company that is not otherwise regulated by the central bank, and because we do not yet have central bank's notification guidelines, it is unclear whether UAE will be able to make the filing with the Ministry of Economy or the central bank, because the Ministry of Economy in its notification form does not have a field for entering lease finance as a relevant activity for notification purposes. So hopefully clarity on this can come in from the central bank guidelines. Next example, please. This is in the context of lease finance business, where there is a company in the UAE that acts as a central treasury company or a cash pooling entity performing a central treasury function for entities and group companies in and outside the UAE. As you can see, it has borrowed funds and on-lent the funds at the same rate of interest. The question is whether UAE Co can be regarded as earning income from a lease finance activity. And on the basis that even though there is no markup being charged by UAE Co, on the basis that there is consideration for the loan provided by UAE Co to its subsidiaries, it will be regarded as a lease finance, as carrying on a lease finance activity and earning income from such activity. Next example, please. Now, this is in the case of headquarter business. Again, many businesses in the UAE, many entities would be performing a group function, a group coordination function, and assuming group activities, having the group CEO, CFO, and other heads of taxes responsible for operations of the group. In this case, there are three scenarios. The first scenario is where the UAE Co incurs the costs for coordinating group activity and does not recharge those costs. Scenario two, the costs are recharged on a cost basis. And third, the recharge is on a markup. In this situation, in scenario one, even though there is a relevant activity being conducted, but because the UAE Co absorbs the costs and does not recharge them, there is only a notification requirement as there is no income from the relevant activity. Whereas in the other two scenarios, even though there's recharge at cost or markup, this will be regarded as a relevant activity being conducted and income being charged from or earned from that relevant activity, because the guide clarifies that income in the context of the regulations refers to gross income from all activities and services, as opposed to income that may be accounted for as income in the books of accounts or where there is a markup or profit element to that income. So those were some of the examples. As we bring the session to a close and before we can take Q&A, just some of the key takeaways from the session today. I think we've discussed some of the relevant activities and the examples. I think the key message is that the test has to be met for each relevant activity. There are some exceptions provided in avoiding duplicate reporting, but you need to see whether you fall within those exceptions. The compliance is mandatory for all entities that undertake a relevant activity. Now, in order to determine, therefore, whether you undertake a relevant activity or not, all UAE entities do need to look at the regulations and look at their activities beyond what's stated in the license to see whether they fall in these regulations, and including government entities or government-owned entities that need to make the notification in order to claim the exemption. The deadlines are progressively from 31st of May to, and now the outer limit of 30th of June. And there are penalties for non-compliance, as we touched upon. So extremely important that this month businesses are focused on getting their relevant activity assessment and notifications in progress or get them underway. And some of the practical challenges that you need to think about when you're filing the notification form is around multiple branches of same entities, multiple licenses in the same entity. Do you do multiple notifications or a single notification? What is meant by income subject to tax outside the UAE, which needs to be disclosed in the form or ticked in the form? And I think Anuj touched on the point on the tax residency of branches and whether you can say that the branch is really resident in the location of the head office or in location where the branch otherwise carries on operation in other jurisdictions. So with that, I'm going to hand it over back to Reese, but a parting message from the Ministry of Finance as well. It's fairly self-explanatory in terms of what compliance is and what businesses need to do. With that, Reese, I'll hand it over back to you to run through the Q&A.
Thank you, gentlemen, for an excellent discussion. As Nilesh has pointed out, we'll now address some of the questions that you as participants have put through the chat box. Some of them are sort of coming themes, so I might sort of put them together and paraphrase them if that's okay with you. Can I just go to the next slide, please? So whilst we address the questions that have come through, As you can see on screen, we generally propose a three-phased approach with our clients. So please get in touch with Nilesh, Anuj, or your regular KPMG contact to discuss your particular situation and identify the best way going forward. So now moving to the questions, and some of these as they've come through have been addressed in part through the slides. So I might just touch on them briefly and ask our presenters just to confirm an understanding. But so the two related questions are, and maybe this one goes to Anuj. Could you confirm that if you are not carrying on a relevant activity, then you do not have a filing or a notification obligation? And a follow-up question is that if you determine that you do not have a relevant activity, is there any harm in filing a notification to that effect by the deadline?
Thanks, Reese. So I think first question first, and this is where the deviation occurs between mainland entities and free zone. So the Ministry of Economy as a regulatory authority has clarified that the mainland entities should file the notification only if they are undertaking relevant activity. But for free zones, as I mentioned earlier, they are treating it as a mode of communication. So you do need to file the notification irrespective as a free zone entity, irrespective of whether you are undertaking a relevant activity or not. On the second question, I do agree as good governance, there shouldn't be any harm in submitting the notification. Having said that, the critical path remains on what basis do you take an informed and accurate decision of classifying your entity in one, more than one, or none of the 9 activities. Back to you, Reese.
Thank you. So next question is perhaps for Nilesh. And Nilesh, I think you covered this off in one of your example slides, but just wanted to round it up because a couple of people have raised similar questions. It's just to confirm that related party or intra-group financing arrangements such as cash pooling, on lending and so forth, those are included as lease finance relevant activities?
Yes, Reese. So to the extent the intra-group financing or third-party financing are for consideration. So to the extent there's interest-bearing intra-group or third-party loans, those are in scope of lease finance activity. Providing intra-group guarantees or guarantees on behalf of group companies are not in scope of lease finance.
Thank you. So next question goes to, so as you've discussed that the report, the notification and then the reporting obligations are to the various or the relevant regulatory authorities, and some of those have been more prompt than others in getting the information out to their regulated body or regulated entities. So the questions are if we have any update on when the JAVSA requirements and deadlines will be announced, and similarly whether the central bank, for those sort of banks and others that are regulated by central bank, if it has announced its deadline and template forms and so forth.
I can take that. So I'll answer it as follows. Firstly, if you look at the latest communication released by Ministry of Finance just about a week back, they clearly mentioned that 30th June is the most extended, and if a correct inference is drawn, it's probably the penultimate due date for filing the notifications across the board. Yes, JAVSA, as compared to other free zones and even central bank, their formal announcements are eagerly awaited by many of us, and it is equally likely that they might send one-on-one email notifications to their constituent companies, which we have seen happen in some other free zone instances as well, communicating the 30th June. So I would ask each one of us to have a keen eye on whatever communication related email IDs have been submitted with your regulatory authorities to keep a check on that. Otherwise, for all practical purposes, it'll be fair to assume 30th of June to be your deadline for notification filing.
Okay, thank you. And there's maybe just keep you on the line for the next question. It's where, and this again has come around in a couple of different variants, so I might just club them together. If you have a foreign company that has UAE branches, whether either one branch or multiple branches with separate licenses, do you club them all together, both branches and head office, or treat each branch as a separate reporting entity for ESR, separate from the other UAE branches and separate from foreign co-head office?
Right. And I think this is a very popular question in branch context. So while legally we understand branch to be a mere extension of the headquarter entity, for ESR purposes, the words used and the intent is very well to recognize branch as a separate legal entity. And unless you have a case, which I was trying to allude towards earlier in the presentation, where a mainland entity merely has, or a foreign company has multiple branches, only because of the licensing requirements, but ultimately it's the same activities undertaken across the board, then probably you are under a scenario where you could file one notification. For all practical purposes, again, a branch is an independent legal form, and each branch will also have to independently analyze where they fall in scope, out scope, and accordingly notify the mainland or the free zone, as the case may be.
Thank you. Nilesh, maybe next question for you, and it goes to, you were discussing around whether the management of the entity is and board meetings and those kind of requirements. And a couple of people have posed the question, well, how does that work in now an electronic world, and certainly a post-COVID-19 world where the physical location of people tends to be less important? You can have virtual board meetings, electronically signing documents from anywhere in the world. Is there any concept of how that will play out in the context of these regulations?
Yeah, so very recently, and the last week, the notification from the Ministry of Finance has clarified, following OECD's similar approach. The Ministry of Finance in the UAE has clarified that where on account of COVID-19 situations, if there are travel restrictions or quarantine restrictions, then the authorities will have a more reasonable approach and a considerate approach as far as board meetings are concerned. But it's only until the COVID situation improves. So if there is a board member who's physically outside the UAE and would otherwise have traveled to the UAE but cannot due to the current situation, a board meeting convened on a virtual basis will be regarded as a valid board meeting. It's important that the company documents this as a temporary measure on account of COVID, but certainly in the post-COVID environment, the expectation is for physical meetings to resume in order to demonstrate and prove substance.
Anuj, question for you, and we've had this in a few different ways, but if you form the assessment that your entity has several or multiple relevant activities, do you notify each of them or just pick the primary or most significant relevant activity?
Right, and I think this assessment is very much the critical part in the phase one, as you all can see on the slide, where the multiple data points, and this is a multi-dimensional view of your actual operations during the financial year. And depending upon where you fit in on the materiality of the various transactions coming in, ultimately you will determine whether which one takes precedent and which one takes the lead. But the notification will have to be filed at an entity level. Again, whether a branch or LLC doesn't matter. And you are likely then in this scenario to maybe tick more than one relevant activity, depending upon, as I said, cumulative effect of your actual business operations during the course of the financial year.
Thank you. And just a follow-up question that someone has posted is there a penalty, or what is the consequence for failing to file the notification by the deadline of say 30 June?
So as one would read the penal implications, they talk about penalty implications on account of non-compliance, and which means it opens the door for the trigger to be any non-compliance. Yes, of course, there's no specific mention about notification non-compliance as compared to maybe the economic substance report non-compliance. It's a summary penalty, which in my view gives more leeway to the regulators to trigger it nonetheless on account of any inaccuracy or any non-compliance.
Understood. Nilesh, question for you, and it goes to your example slide of a head office or a headquarter company. And the question has been posed a few different ways, but fundamentally, is merely holding shares in subsidiary companies enough to qualify as relevant activity, or do you need to be more active in the management of your subsidiaries?
So the passive holding, the passive activity of holding shares in subsidiaries, whether inside or outside the UAE, will be regarded as a holding business. And the only income that you are expected to earn from that holding function is either dividends or capital gains. If you are, but obviously, if you are a holding business, you need to demonstrate appropriate substance in terms of employees or premises to prove that that holding function is being performed. So your holding activity could involve one investment that you hold and you manage, or it could involve multiple investments which generate dividends and capital gains. Obviously, to the extent there are multiple investments that the holding company makes, you do need to demonstrate that you've been actively involved and that there are adequate people responsible for that multiple holding function. So a facts and circumstances test, but the key is that for holding company business, the only stream of income must be dividends or capital gains. If the holding company carries on any other commercial activity, it falls outside the scope of a holding company business, but then the company needs to consider whether it falls in scope of another relevant activity on account of that commercial activity.
Thank you. Look, with one eye on the clock, I don't want to impose on people's goodwill too long by going over time, but I'm going to just pose one final question, and I think maybe this goes to Anuj, just following on from the discussion around JAVSA, and of course there are some other regulatory bodies, and for instance, I think RAC is one where they have not yet confirmed a 30 June deadline or provided much information. The question has been posed, well, if we still don't have the information, what do we think will be the consequence if we are just not in a position to make the notification by 30 June, if that's when they notify, or if that's when they put the deadline and there just is not enough time to comply?
Right, and at the cost of repeating, I'll still maintain that the regulations have been out since April 2019. So as we are today, we are already sitting knowing about the regulations and the flurry of other activities on FAQs, relevant activity guide, since probably more than a year. While the notification format is literally the last mile, I think by all means the entities in this instance should go through the critical path of assessing what is the in-scope and out-scope impact for your entity, and then effectively be in a position to push the submit button, which in most likely scenarios could be an online filing, very similar to the formats we shared in our webinar. It's same. There will be nuances, but broadly speaking, you will be in a position to have 80% of the work done, and then just pushing the submit button when ultimately things are more known. So highly encouraging you to go through the critical path and be ready, thinking 30th June to be the deadline nonetheless.
Thank you. And of course, we here at KPMG are more than happy to help you do that. As you can see on the screen, we've put a lot of thought into the right way to assess these rules and meet these deadlines with a phased approach. So look, this session has been recorded, and we'll send through a copy to all participants. But importantly, a lot of people in the question box have asked, how can we as KPMG help, or how can they as regulated entities form a view as to whether they're going to be in or out? So what we're going to be doing is we've developed an online ESR survey tool, which we will send a link to you. And the purpose of that tool is so that in very short order, by answering some sort of survey type questions, you can get a preliminary assessment of whether the rules are likely to apply to you, and therefore whether you need to go on to the next step to do a detailed assessment of relevant activities and so forth, and your notification and then reporting requirements. So a link to that self assessment tool will come through shortly after this seminar, which we hope you found to be helpful. And we ask that you provide some feedback through the feedback page so that we can continue to improve. As I said earlier, once we get through this notification period, we will follow up with more seminars and materials on some of the detail on the reporting and the exact substance requirements. But until then, and on your behalf, I'd like to thank Nilesh and Anuj and wish you a good afternoon. Thank you.